Welcome, grade 12s. Today you are with Ms. Tembayi from Richard Vacha High School, Buffalo City Metro District. My focus for today's presentation will be on analysis and interpretation of financial statements. And I will also touch on the corporate governance question. My presentation will look into the following areas. I will do the overview of the analysis and interpretation of financial statements. I will explain the categories of financial indicators, namely profitability or operating efficiency, liquidity, which is also known as the working capital, solvency, risk and gearing, shareholders' returns, earnings and dividends, market prospects. Then lastly, I will be looking at shareholding under the topic of analysis and interpretation of financial statements. Then the last topic that I will be presenting about in today's session will also be on corporate governance. Now, you need to ask yourself a question. Why do we analyze and interpret? Why do we analyze and interpret the financial information? Remember, grade 12s, it is very important for the business to assess their performance, how they have performed for a specific period, for them to know where they were successful and where they need to improve, so as to ensure that they always keep the shareholders, meaning that the potential shareholders, interested to come and invest in the company. Now, we can only do that when we analyze and interpret the financial statements. In the process of doing that, we must be able to answer certain questions. For example, how well the business manages its expenses. Remember, a business with good control over its expenses is able to minimize its expenses in an attempt of improving its profits. That can only be achieved when we analyze and interpret the financial statements. The second question that we must be able to respond is the question that says, will the business be able to meet its short-term debts? By short-term debts, I am referring to current liabilities. Are we having enough current assets to cover our current liabilities? All those questions can be answered when we analyze and interpret the financial statements. We must also be in a position of being able to answer whether will the business be able to meet all its debts. If you can link the first line and the second line. From the first line, I referred to the short-term debts, meaning that we're looking at current liabilities versus our current assets. Then for this one, we're looking at the fact that will the business be able to meet all its debts? By all, it means that is our business in a position of being able to pay off all its debts, both the non-current liabilities and the current liabilities. We must also be able to explain to what extent is the business financed by loans, which are also referred to as the borrowed capital. All these questions can only be answered when we analyze and interpret the financial statements. Now let me touch on the first category of financial indicators, which is profitability, which is also known as operating efficiency. Now, grade 12s, as we are looking at this category, our focus must be on the statement of comprehensive income. Remember, to work out your profitability financial indicators, you use the information coming from the statement of comprehensive income. So these indicators will be those indicators that are having the components of your statement of comprehensive income. Now, if we're looking at this category will be measuring how well the business controls its expenses in order to increase profitability. The keyword here is expenses, meaning that our focus when we are looking at the profitability financial indicators is on expenses. Now, you must ask yourself this question: when am I expected to comment using the profitability financial indicators? I will only comment using these indicators when the question is asking about the control of the business over its expenses or the control of the business over its operating expenses. That is the only time I can use the indicators from the profitability category. What are these indicators that I am referring to? The first indicator is gross profit on cost of sales, followed by the gross profit on sales or on cost of sales. If you can have a look, these two financial indicators from the top are not bold. Reason being they are not bold, it is because we cannot use them when we are commenting on profitability. They are indicators that we must not quote or mention when commenting on profitability. Mr. Mbai, which indicators must we use when commenting on profitability? These are the bold indicators that we must always mention when commenting on profitability. I am referring to operating profit on sales. I am referring to operating expenses on sales. And lastly, the net profit on sales. Let me repeat myself. We have 5 indicators under profitability, but from the 5, 2 of them are not allowed. We are not allowed to use them when commenting on profitability. For example, I have mentioned your gross profit on sales, your gross profit on cost of sales. Let me give an example why. For example, looking at the gross profit on cost of sales, this indicator is also known as the markup percentage or the percentage gross profit. Remember, the business or the directors may decide to increase the markup or decrease the markup, meaning that these 2 indicators will not be reflecting the business control over expenses, because these are deliberate decisions that the business takes either to adjust the markup up or to adjust the markup down. You must also know the reasons why they would do that. We can adjust the markup down because we want to increase profits. Remember, if the markup is being adjusted down, that would make our selling prices to be low, meaning that when selling prices are low, we are in a position of attracting more customers to come and buy. Therefore, we can achieve increasing our sales and the gross profit. We can decide to adjust the markup up. When we're adjusting the markup percentage up, that would mean we are making the prices expensive. Remember, if our prices are low, the demand may exceed the supply, which may lead or may result us in not meeting the demand of the customers. Then when we are making those prices to be expensive by increasing the markup, we are trying to control the demand so that it does not exceed the supply. Now, how can I see that my business is profitable? Remember, the 3 indicators that we use are those that speaks about the profit, the operating profit on sales, the net profit on sales, meaning that these 2 financial indicators which speaks about the profit must always show an increase. Remember, a business can increase its profits when it is able to control or to manage its expenses. Now, that is the only time we can say that the business has good control over its expenses and is thereby profitable. Now, lastly, we have this one indicator which speaks about the expenses, which is your operating expenses on sales, meaning that for us to say that the business has good control over expenses, our expenses must be minimized at all costs, meaning that this indicator must always show a decrease or remain constant for us to say that the business has good control over expenses. Remember the rule of commenting. When you are required to comment on profitability, you must not forget to quote the financial indicator. The financial indicator must indicate the trend. Has this indicator increased compared from last year to current year or decreased? Then the trend must be accompanied by the figures. Then for you to get full marks, you must make sure that you give a general comment. Let me give an example. I have said, you quote the correct financial indicator, meaning that the financial indicator, for example, that you can quote when commenting on profitability is operating profit. By quoting operating profit, you're getting yourself a mark. By indicating the trend with the correct figures, you're getting yourself another mark, meaning that for each indicator, you are entitled to receiving 2 marks. Then if the question required 2 indicators, then you must also do the same procedure. When you are commenting using the second indicator, for mentioning it or for quoting it, you're getting yourself a mark. For indicating the trend we said it's an increase or decrease, then the trend must be supported by the figures, meaning that you will get yourself another mark, meaning that you have got yourself 4 marks. Then for giving a general comment, then you qualify for 2 marks. Now, you must always remember that we can only use the profitability financial indicators when the question says comment on the control of the business over expenses, or comment on how profitable the business is, or how well the business manages its operating activities. That is the only time we can use the profitability financial indicators. You quote the financial indicator when commenting, you indicate the trend, increase or decrease, then you support that trend by mentioning the figures. Please make sure that, learners, you quote the figures as they appear from the question paper. And one thing that I love about analysis and interpretation of financial statements, all the answers are in your question paper. That is the only topic where you are given the answers in your question paper. Let me proceed to the second category. On the second category, we're looking at liquidity, which is also known as working capital. When looking at liquidity or the working capital, that's where we want to check whether will this business afford to meet its short-term debts, meaning that our focus is on current assets is to current liabilities. Can we be able to pay our short-term debts from the available current assets, which are converted to cash? Now, when can I expect to use these liquidity financial indicators? Which question will be asked where I will be required to only comment using the liquidity financial indicators? I can only comment using the financial indicators when the question says comment on liquidity or comment on how well the business is managing its working capital. Remember, I said working capital is the same as liquidity. Or the examiner may also ask you to comment whether this business will be able to pay off its short-term debts. That is the only time I am allowed to comment using the liquidity financial indicators. Then to remember which indicators falls under the liquidity category, you must always remember this abbreviation or acronym, which is CADS-C. CADS-C will help you remember the indicators that falls under the liquidity category. The C from our CADS-C stands for current ratio. A stands for acid test ratio. R stands for rate of stock turnover. And D stands for debtors collection period. Then S from our cards stands for stock holding period. Then creditors, then the last C stands for creditors payment period. Now, let's go and explain what each financial indicator means. When we are looking at the current ratio, remember the current ratio is calculated by taking the current assets, then current assets is to current liabilities. That's how we're calculating the current ratio. Meaning that from the current ratio, we want to check, will our current assets be in a position of being converted to cash so that we can be able to meet our current liabilities. Meaning that for us to say that our current ratio is in a good position, it therefore means that the current assets must exceed the current liabilities. Because when current assets exceeds the current liabilities, let's say if our current assets is 2:1. If current assets is 2:1, 2 represents the current assets, 1 represents the current liabilities. That would mean that for every 1 rand that we owe to our creditors, we have 2 rand available in order to pay. Meaning that we do afford to meet our short-term debts. In that case, that would indicate that the business is in a good liquidity position. But don't forget that current ratio alone cannot indicate to us that the business is in a position of meeting the short-term debts. We must check the acid tester ratio. What is your acid tester ratio saying? Remember, acid tester ratio is calculated by taking your current assets, then you minus your inventory, then is to current liabilities. So we want to check, remember, your inventory is not the most liquid asset. Stock must first be sold for it to bring in cash into the business. So we must exclude this inventory to check if the stock is not sold. Can this business still be in a position of meeting its short-term debts? If our asset tester ratio is above 1, that would indicate that the business can meet its short-term debts even if the stock is not sold. What will that be indicating about the business? That would indicate that we do not have too much cash that is tied up in stock, or we do not have the stockpiling. Now, let me go to the third indicator, which is the rate of stock turnover. The rate of stock turnover, it is the times in a year in which stock has been replaced. We can only be satisfied with the rate of stock turnover when that financial indicator is high. Because when the rate of stock turnover is high, it therefore means that the stock was fast selling for that particular financial year. But we cannot be satisfied with the rate of stock turnover when the financial indicator is low. That would mean the stock is not fast selling. Remember the problems associated with stock that is not fast selling. The stock may become obsolete, meaning that when the stock is obsolete, customers will not be interested to buy that stock because it's outdated. Therefore, the business will therefore be forced to reduce the selling prices of the stock so as to ensure that the stock is cheaper to attract customers to come and buy the stock, which therefore means that we will not be generating enough funds as we would have if the stock was fast selling. Let me repeat myself. We will only be satisfied with the rate of stock turnover when it is high, because it indicates that the stock is fast selling, meaning that we are in a position of generating funds from our stock to pay for our short-term debts. But when the financial indicator is low, which is your rate of stock turnover, that would indicate that the stock is not fast selling, meaning that we are not generating enough cash from our stock to be in a position of meeting our short-term debts. And in that case, that would mean that the business is not in a good liquidity position. Now, we have the next indicator, which is debtors collection period. Debtors collection period measures the time that these debtors are taking in order to pay their short-term debts.